Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is October 24th, 2024, and we're going to talk about oil and energy against gold and inflation. And what we're seeing today is we actually are going deeper into earnings season. We have a lot of big players this next week. We have Capital One Financial here in seconds, where we're going to be able to see some of the results in one of the biggest consumer lenders over the last quarter. But as we're watching the market, we're looking at the S&P 500. A couple things we want to pay attention to first is the economic data and the movement of equities. So equities we've seen push up to this new high, and every day this week we've kind of melted down a little bit, either making a lower close or a lower shadow every single day. As we're looking at this move, we're seeing this push higher and higher and higher in our inflation measurement. This is gold versus treasuries. Now that can happen because gold is going up, it can happen because of treasuries going down, or the combination of the two to tell us that we still have inflation on the table and inflation as a concern. The S&P 500 is not breaking higher. It's not really selling off much, but it's just staying stuck here at the top after pushing to these 52-week highs. Now a lot of this move higher has been on lighter and lighter volume, and that's why we're paying attention to it very carefully, because failure on a breakout with low volume means that if we pick up the volume on the way down, it really could accelerate. But we keep getting this lift towards the end of the day, recovering off these low shadows as institutional investors seem to be stepping in towards the last half of the day, recovering those lows. They're buying the dips. The question is, at what point do they stop buying the dips and start selling the peaks? And it's really interesting because we just had the Capital One Financial Report come out. It's not going to show here on Thinkorswim quite yet. But Capital One, as you can see, was rolling over, and markets were pricing in lower and lower and lower and lower expectations for Capital One Financial all week. This is actually a bigger sell-off than we've seen across the broad markets. And they had a surprising earnings. Earnings came out much better than expected. They reported 4.51, so $4.51 earnings per share versus the expected 3.77, and they made $10 billion in revenue versus $9.87 billion. Now, we haven't had the conference call yet. We don't know what it looks like as far as new accounts. We don't know what they're doing with defaults. But on the surface, the top line numbers that have already been released are showing a major beat in the market. So if we look at this from the intraday perspective, this would be a significant outperform based off what the market is expecting. So they're seeing lower highs, lower lows, lower highs. Now, after this report, we should see a spike higher if the market believes this is really, really good. So if we go into the intraday, there it is. And the spike initially slammed it lower, gapped up, traded higher, traded back, went right back to the original price, traded back up again, and we're seeing about a $5 improvement in the underlying price off of this beat of, what would we call it? Maybe 10% beat in revenues and a 20% beat in earnings. So quite significant as far as what was expected with what happened here, which is surprising to me because we already know that the consumer is already tapped out at $1.1 trillion in consumer finance and consumer debt. But the numbers are the numbers. And so as we're seeing this spike higher, this is showing that the consumers are still using their credit cards, still using the debt, still paying for stuff. And it'll be interesting in the conference call to hear if they are increasing the number of auto loans, which is the big component of Capital One Financial as well. Right now, the spike is there, and if we can clear that high, we really could see this erase since we're at 158. We've already erased all the sell-off for this last week. Today, all the way back through the week, and we're testing Friday's closes. So we've erased all the selling of this week off of earnings and pushing up to retest Friday and Thursday's levels. So the pricing in of the earnings, they've said, oh, I guess we were wrong, and they're pricing it back to where it was before. Now, is that enough to lift the market? Probably a little bit, but not where we'd think that this is an overall lifting of the economy. So if we go back to the S&P 500, and we should see a little bit of lift in the aftermarket here, pushing this up a little bit. And sure enough, that's what it did. Just pushed it up a little bit. And you can see we're kind of stalling out now. So this is probably it. That was all the reaction we're going to get in the broad market. Back to the discussion, though. If we're looking at the market and we're looking at the economic data and we're looking at the things that are going on, yes, Capital One Financial is doing well and outperforming. That can be a good and a bad thing for the consumer. It does tell us that consumers are spending money, but what are they spending the money on? As we're watching the moves, a couple things I want to look at. One, under Forex Factory, you can see we have new home sales outperformed. That's a very good sign. We can see that services increase. That's a good sign. We can see manufacturing increase. That's a good sign. And we see new weekly unemployment decline. So all of the data today would be fairly positive, which we didn't get a very positive reaction early in the day, but the economic data seems to be fairly positive, and the news out of Capital One Financial seems fairly positive. So I asked the question again, where are we spending the money? What are we seeing in the overall markets? Earlier this week, we commented in the main room about Walmart. Walmart making these new highs, new highs, new highs. Last week, we talked a little bit about this in the Friday live call. Walmart has been reaching new highs, new record highs. This is the discount stores. When the discount stores are doing really well while the brand name stores are doing poorly, it's an indication of substitution in the economy. If there's substitution, inflation doesn't adjust very well for substitution. What do I mean by that? I mean that inflation doesn't look at the fact that we are maybe normally buying steak for dinner, now we're buying hamburger. That's always been the representation that we did in economics when I was in school. And we always said, look, we don't substitute in the fact that we went to McDonald's instead of Texas Longhorn or Longhorn Steakhouse. And so the substitution says that prices may be coming down. If we were always looking at steak prices, maybe steak prices have come back down because there's no demand for steak. If there's no demand for steak because everybody's buying hamburger or tofu burger or turkey burger or other substitutions that are cheaper, and therefore the demand for steak goes down, it would look like inflation is pulling back. Well, here's the thing. We're not seeing the signs of inflation pulling back, at least not compared to gold versus TLT. We're not seeing the signs that we're seeing demand decline because we're going into the discount stores like Walmart. Walmart's making new highs, record highs yesterday, and pushing higher well ahead of earnings. So potentially, we're seeing that money is moving into the discount substitution and showing that the consumer, again, is being more cautious in how they spend. They're still spending, but they're not going to the outlets that are going to be brand name. So Lulu has climbed back up through here, but you can see just in this last 6 months, still half the price of what it once was. And if you look at the last year, we are still dealing with nearly a 60% decline in something like Lulu. Same thing we could do with Nike. Nike's gone from 123 all the way down to 79.80. We're still seeing a movement away from the brand name tickers and into the discount stores. Kroger has a little bit of a pullback ahead of the 52-week high, but had a nice breakout yesterday. The pullback might be a good opportunity to buy on a small bounce and push Kroger higher. There's another discount store, and as one of my favorites, Costco is holding its own all the way up to the top. But if we're spending money on the discount stores, on the big box stores that are going to buy us stuff for cheaper and bulk quantities, it's interesting to see that we're buying new homes. New home sales are going up. So let's take a look at the 10-year Treasury yield, and we'll circle back to energy here in just a minute. The 10-year Treasury yield, we're getting the highest number of new home sales than we've seen in a year and a half, and yet we're doing it on the highest yields or highest mortgage rates since July. So all of this decline, going from 4.2 to 3.6, has been reversed all the way back up to 4.2, back to this area. So bonds have fallen down. We've seen this price hit through here, and we've unwound future rate cuts. Fascinating to see that the market has said, okay, so you're not going to cut rates, and maybe that's the reason why. We went into a holding pattern hoping that these lower highs, lower lows, lower costs were going to keep going, and we're waiting and waiting and waiting before we would buy those new homes. And now that the market has turned, we're not expecting lower rates, or the yields have turned. We're not expecting lower rates. All the people that said, I was waiting for lower prices, lower yields, lower mortgage rates, they've given up on that wait and saying, I don't see it happening. I've got to buy this house. And that's the only explanation I can really see in rising yields, rising mortgage rates, and yet rising new home sales. There is another possibility, but I don't know this information. I won't really know until we get some of the earnings from these home builders, and that is whether they're selling the homes at discount, paying down the rates, and taking a bigger hit. And if that's the case, then we should expect some pretty dismal earnings reports from this last quarter. One, because home sales sold off and dropped dramatically, and two, if they're rising now because they're getting desperate and selling out their inventory or doing more interest rate buy downs for their customers, that will definitely hurt the home builders. A couple of other aspects that I look for. If gold prices are rising, theoretically we're hedging against inflation. If crude is falling, theoretically demand is low, at least low compared to production. That's what we're looking for, the comparison between how much oil is being produced versus how much oil is being demanded. And so as we're looking at this chart, you can see we're way down off of $85 a barrel, $87 a barrel high. We're down at 70. We're closer to the lows than we are to the highs. If we look at the energy report from the Energy Department, they're not really showing a decline in demand. They're showing that, hey, world consumption is still making higher highs, higher lows, higher highs, higher lows in total barrels, but our production, the blue line, has been rising in lockstep and actually accelerated through. So what we look for is we look for the times that the production is at a faster rate than demand. So in 2019, 2020, we see that collapse really fast. That's when oil prices got knocked down and when we had no demand. Well, we've restored that demand. We're at a higher demand than we were pre-lockdowns, so back to 2019 high as far as demand, but the production has been increasing at a faster rate. It is interesting to see the oil prices are down at these lows, and yet we're looking at next quarter that we're seeing those draws in the inventories getting less and less, and possibly by the end of 2025 being a build, meaning production is going to outperform demand. If that's the case, oil prices forward looking should remain relatively low. If demand flattens out and rolls down, then that'll become even more significant and be a big indication as far as on the total economy and consumer. And the other instrument I like to look at, and I'll talk about this more in the morning in the TheoTRADE Live, is copper. So copper spiked all the way up to 520 roughly, all the way back down to 4, erasing all the demand going back to March. And then we created higher highs and higher lows. This is a good sign of demand, and yet we're fading back down again. So we're in the middle, but we're in the middle of the I don't know, I'd say the middle of the big demand increase from early 2024, but it doesn't look like it has legs to keep on going the way I read this. This does not look super confidence building as far as this is concerned. And in the shorter time frame, anytime we see copper falling while gold prices are going higher, oil prices falling while gold prices are going higher, this is an argument that we could assume that there's some stagflation. Inflation without the demand, inflation without the growth. Now this is kind of fun to watch in real time because as I'm doing this video, I am watching the broad market, and what we're seeing is that rally, that reversal that we saw in the overnight that was lifted by Capital One Financial, that I said makes up a small component of this and the consumers are stretched. What we're seeing in the aftermarket is we're erasing all of that. So here we went into the close, we spiked up higher, and we've given that all back. So we're all the way back into the same area that we were since 10 a.m. this morning. We've traded back to that area. So we erased any breakout and pushing back into the lows. The breakout and acceleration in equities just doesn't seem to have legs, even with better than expected earnings reports from Tesla, from Capital One Financial. And so we see those struggle. Now, if that's the case, if consumers are strapped and we see stagflation, and we already saw earnings from Southwest really hurt the company, major sell-off, almost a 10% decline, and we're seeing these pullbacks, is that a further indication that we're seeing less demand for the things we don't need? Are we going to see Marriott continue its downtrend before earnings? Are we going to see Las Vegas Sands reverse off of this high and start to drop? Are we going to see Wynn continue to go lower? And we're looking at this as the leisure sector, the non-essentials, and the market's not being able to push higher and stagflation is there. This will likely get worse while we see money continue to move into safety. And I think we're seeing the first signs of that even with TLT after this massive sell-off, lower highs, lower lows, lower highs, lower lows. If we're getting more concerned about equities, we might see increase in demand for bonds. And what we did is we sold off, we broke this support, and defended this support level. If you want to look at that close price, that was almost exactly the low of a gap down close up and then a follow through to the upside. So this could be the setup to be going back into bonds, not necessarily going for the record high, but maybe back to 98. And the interest rate or the yield that is paid as part of buying TLT. So I'm watching for these turns in bonds to go higher as a defensive play. I'm watching for equities to slow down. I'm looking for the return to strength in consumer staples and likely selling in energy. The energy is going to struggle, and we're probably going to see lower earnings and lower revenues for energy stocks. That's what I'm looking at, and we'll talk more about it in the morning. So join Brandon and I in the morning live, and we'll talk to you again next week.